If I don't immediately after I talk about what's scaring us use that Shakespeare quote, just yell cut.
Okay.
All right, here we go. Welcome everybody to this week's commentary. We thought in honor of Friday the 13th, we'll talk about something that's been scaring us with respect to investors, and that is really what we see as the impending perfect storm for a lot of people as they enter into retirement. You may recall the movie The Perfect Storm that came out 15, 20 years ago. And in that, there's this great scene where the weatherman's talking about these three fronts that are about to collide to create this perfect storm. And similarly, we see three fronts, realities that are going to likely collide here soon in what we think could become a perfect storm for a lot of retirees. And they're the following three things: current valuations, where we're at in the market cycle, and then just the reality of boomers that are set to retire here in mass, really as it begins to peak here over the next few years, looking to be able to live off the wealth they've created at a time where those valuations and market cycles might dry up some of the traditional places people have seen return. So we're going to talk here in a minute about how we think people can get through this. But before that, wanted to touch on a few of the things that we see again within these storms. So the first that I mentioned was valuations. Goldman Sachs put out a great report we shared in our January 12th commentary where they looked at, for the first time in 118 years, you have U.S. stocks and bonds both trading at 100% valuation levels simultaneously. And so again, that diversification even between the two that's historically been, as one was strong, the other was weak, and vice versa. Now you have them both trading at peak valuations, which again is a dangerous thing for those people solely invested into those two assets. Second is where we're at in the market cycle. It certainly relates to that valuation. Again, we've shared some of this information before. Research Affiliates put out a great piece where they looked at the probability of that traditional 60-40 U.S. stock and bond portfolio being able to help people get the return that they would need. They put that at 5%. And the probability that they came up with was 0, which seems stark. And whether you want to quibble that it should have been 1 or 5, the point is it's extremely low, which makes sense if you look at bonds giving you a 2 to 3% type rate of return. You would need to have an expectation that stocks were going to do double-digit type returns again for another 5 years on top of the 9 they've already done that. And while that could happen, the probability of it, I think all would agree, is fairly low on a consistent basis. Touchstone, another group we work with, put this out as a piece where they looked at from current valuation levels, the average 5-year return has been 0 or less 80% of the time. Again, numbers that people who are entering into retirement don't want to hear or take a chance. And then third, again, right as these realities are facing people, you have most people looking at retiring and needing to take that income. So here's some things that aren't going to work that I want to touch on just ever so quickly. Number one is excessive risk taking. We run into a lot of people, we talk to them about their plans, and they say, well, I'm going to accept more risk, and I'm building a growth portfolio. The market really doesn't care about any of our intentions or what we call our portfolios. And while in general, taking more risk should result in more return over time, over time, 2, it may not be the time frame that you need, and sometimes risk just ends up being risky and not giving us the requisite return. The next thing is stock picking. You're not going to out-stock pick bad planning any more than you're going to outrun a bad diet. And yet we see this as, again, one of those urban legends that continues to get perpetuated. Plenty of people in my profession that continue to hold this out as their value proposition. It's a nice thing to believe, like magic products and pills and all the rest of that might be for any of our diets or health plans. But the reality of it is it doesn't work. In fact, 90% of the time, people fail to outpick the U.S. stock and bond market. And I'm not talking about local broker Jones. I'm talking about people whose full-time jobs are to run money on a fund level with tremendous teams, research, and resources. And so putting your faith there again, and I would suggest is misguided. Finally, and related to that is market timing and products, and again these silver bullets. They just simply don't work on a repeatable basis. Last thing we've seen is just a tremendous amount of market apathy. Even when you point a lot of these things out, people they maybe don't want to believe it, or they say, well, the person I'm working with is really nice, and we certainly hope and believe that advisors are nice out there, and that they're people think that we're nice, and yet again, nice alone is not enough unless that means that whoever you're working with is going to enable you to move into their home if your plan doesn't work out. And so really, what does work and what can we look at? When we talk portfolio designs, we talk about building a plan and a portfolio you can live with. And live is actually an acronym around here for us, and it talks about liquidity and making sure that you know what you can give up to enhance return and income, as well as what you need for unexpected costs. Income, how much income can you drive off the portfolio, again, for your needs. Volatility, how much volatility do we want to design a plan to be able to have to match what our clients can live with. And then finally, expected return, that amount of capital appreciation beyond the aforementioned income stream that can offset inflation. This week, I want to focus on that income stream. And to us, when we're talking about this perfect storm, that's the piece that we need to focus on. I'm reminded of the old Shakespeare quote, things done well, or people that do things well and with a care, are exempt from fear. And so that's what we hope to do, is to design plans with enough care that we can exempt our clients from fear. And with respect to this perfect storm we see developing, the way we can do that is through creating an income stream, utilizing different asset classes and different strategies that can create an income stream that's sufficient to meet people's needs and independent of any type of total return. If you look at year to date, there's been no return. There's going to be years where there's negative return. All that would mean then is you're going to have to sell off even more of your portfolio to meet your needs, unless the independent shares and positions you have can drive an income stream that you can live off of until those shares can grow enough over time to a point where maybe you can afford to sell them. That's, again, what we think is the key to this. It's quite doable. And how we would suggest people think through portfolio design that are nearing or in retirement. So in summary, whether that's you, if you're nearing or in retirement, or whether it's someone you love, maybe an in-law that you don't want to have move in with you, rethinking and taking this opportunity, this wake-up call that this year's volatility has given all of us to understand that the good times can't continue indefinitely. To get your plan right, to get your portfolio right for what's next is so key. Just as past performance isn't any guarantee, we tell people past planning or what's worked in the past from a planning standpoint isn't guaranteed of working in the future, and in fact probably won't. With that, for our clients, thank you so much for entrusting us, and for those of you who we may not be working with, we'd be happy to go into any of this in more depth anytime. Thanks so much.